Whenever we must assess a project, which will be financed with both debt and equity, we must use a blend of the two discount rates, right? We can't discount the expected cash flows the project will produce with the cost of debt only, if the project is financed with both debt and equity. In the same way, we can't use the cost of equity alone. The discount factor that considers both debt and equity investors is called weighted average cost of capital, or simply known as WACC. It provides a sense of the average opportunity cost sustained by investors for investing their funds in the firm. Let's look at the WACC formula. It has two weighting components: debt divided by the sum of debt and equity divided by the sum of debt and equity. The sum of these two components is equal to 1. This shows us that if a project is prevalently financed with debt, the cost of debt will have a higher weight. And conversely, if a project is financed mainly with equity, the cost of equity will have a higher impact on WACC. We shouldn't forget to mention that the cost of debt component includes a third factor, 1 minus t, that considers the fact that interest expenses are tax-deductible, and the cost of debt is lower than it seems, as it provides borrowers with a tax shield. Now that we know how to find a firm's cost of equity and a firm's cost of debt, it is a piece of cake to calculate its weighted average cost of capital. That's awesome! We are making excellent progress. In our next video, we'll discuss different capital budgeting techniques. Thanks for watching.